welcome to the Daily Insights That Matter. Now, the Indian stock market witnessed a heavy sell-off towards the end of last week on the back of weak global cues caused by the Silicon Valley Bank's crisis. Now, the Silicon Valley Bank's news on bankruptcy led to a huge beating as three major US indices, the S&P 500, Dow Jones and Nasdaq, all corrected by up to 2% on Friday. Now, this led to a weakness in the banking stocks in the Indian markets as well, and the Nifty Bank Index crashed 771 points or around 1.87%, and the most of major banking stocks corrected heavily on Friday. Now, the talk of the town is whether this is the biggest financial disaster since the 2008 financial crisis. To answer that, let's start by looking at what went wrong with this Silicon Valley Bank, which has been America's best banks for the past 5 straight years. Though we will discuss this in detail in our third Umpire episode, which will be released on 19th March 2023, in today's episode we try to understand what happened and how the Indian banks are playing a lending hand here. Silicon Valley Bank is a bank that primarily caters to the startups and venture capital firms. During the period between 2020 and 2022, Silicon Valley Bank's deposits grew from $62 billion to almost $190 billion. Now, how did they grow this fast? Well, back in 2020, a lot of businesses and startups were struggling to meet their working capital requirements and fund their operations due to the after effects of the pandemic-induced lockdowns. So, the US Federal Reserve started reducing interest rates in order to enable these businesses to borrow money at a cheaper rate and to be able to meet their funding requirements. So, a lot of investors started borrowing money at a cheaper rate and used them to invest in various startups, despite the fact that many of them were not even profitable. While the US Fed reduced the interest rates to increase the money supply in the economy, these startups started to get a lot of money as it became very easy to raise funds given the higher liquidity in the market amidst a low interest rate regime. Now, these startups deposited the money that they had raised into their accounts with Silicon Valley Bank for future use. Hence, Silicon Valley Bank had a lot of deposits up to the tune of $190 to $200 billion. Of these deposits, Silicon Valley Bank decided to invest about $127 billion into government securities, which is the US Treasury bills, which are the safest investment vehicles with almost zero risk and are considered default free. But it's important to note that these investments were made at a time when the interest rates were low. And as we've discussed this in our multiple episodes in the past, this led to the inflation soaring. Post the pandemic, as the Fed increased the interest rates to combat high inflation, the bond yields dropped sharply as bond prices and interest rates have an inverse relationship. This led to a fall in the value of the investments made by Silicon Valley Bank in the government securities as the interest rates rose. Now, at the same time as interest rate rose, it triggered a start of the funding winter as investors did not want to borrow more money to fund these startups at a higher rate of interest. Hence, the startups had to go back to Silicon Valley Bank to withdraw their own deposits to be able to carry out their regular operations. Now, to pay off the depositors, Silicon Valley Bank had to liquidate these investments in the government securities, and Silicon Valley Bank sold some of its bonds at a loss of about $1.8 billion. This was the start of the problems to Silicon Valley Bank. Now, in order to pare these losses, the Silicon Valley Bank announced that it was raising $2.25 billion in a share sale, in addition to having sold $21 billion worth of securities from its portfolio, which triggered a bank run amongst all of its depositors, where more and more depositors wanted to withdraw their deposits from Silicon Valley Bank in a panic to avoid any losses of their own deposits. Now, this is still a story that is unfolding as we speak, and we will look to cover more details of the same in our third Umpire episode this week. Now, from a domestic point of view, Indian banks have minimal exposure to Silicon Valley Bank. Additionally, the Indian financial sector as a whole is on a much stronger footing, fairly well insulated and regulated under the supervision of RBI. As far as the markets are concerned, there will be some impact on the sentiment of the market in the short to medium term, as it's a global issue, but it will not affect Indian equity markets in the long run. But talking about the Indian startups, about 40 Indian startups have deposits between $250,000 to about $1 million, and over 20 of them have deposits which are over $1 million each with Silicon Valley Bank. Now, the risk of these companies losing big money is fairly prevalent, and to combat this, 3 Indian banks, namely Axis Bank, Kotak Mahindra Bank and ICICI Bank, have assembled teams to assist Indian startups affected by the collapse of the Silicon Valley Bank. Silicon Valley Bank's collapse has led to a decline in global banking and financial stocks. The US government has appointed the Federal Deposit Insurance Corporation as a receiver and will provide insurance to the tune of up to $250,000 on each bank deposit. Now, though it still doesn't solve the problem of startups holding more than $1 million in deposits, the Indian government will meet with the Indian startups this week to understand the impact and help with the ongoing crisis. Following a 4.3% growth in December 2022, India's industrial production has continued to expand for the third consecutive month with a growth of 5.2% in January 2023. The Index of Industrial Production Data, or IIP, as we know, is a composite index that measures changes in the volume of production of a basket of industrial products across different sectors of an economy, and the core sector output contributes to about 40% of the IIP. Now, according to data published by the Ministry of Statistics and Program Implementation on March 10th, the Index of Industrial Production expanded by 5.2% in January against 4.3% in December 2022. The IIP growth is supported by a broad-based expansion in manufacturing, mining, and electricity output. India's manufacturing industry saw robust output growth of 3.7%, while the electricity segment grew by 12.7% and mining grew by 8.8% year-on-year. Now, if we look at the use-based classification, 4 out of 6 categories posted higher production, while consumer durables contracted for the second straight month, and intermediate goods saw a marginal expansion of only 0.1%. Now, on a 3-month rolling basis, industrial production seems to be picking up pace, majorly driven by domestic demand. According to experts, if the weather remains favorable over the next few months, rural demand could get a further boost, which will aid the output. However, factory output growth of coming quarters may face possible risks due to factors such as increasing interest rates, global economic slowdown, and weak external demand. So what does all of this news mean for you? The impact of the collapse of Silicon Valley Bank is not severe in India per se, as the Indian banking system is more insulated and regulated under the supervision of RBI. However, there will be some impact on the sentiment of the market in the short and the medium term, which could lead to increased volatilities. This will therefore have an indirect neutral impact on you for time being. The domestic demand and expansion in broad-based sectors had supported the growth momentum of industrial production. However, weak global exports and uncertain global economy remains a drag for the country's industrial production. This will therefore have an indirect neutral impact on you. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.